All right, guys. So, I'm just gonna start from scratch. So, there's calls and put options in option trading. It's just a call and a put option, and then it gets you use them together to make spreads. So let's just start off. So a call option is essentially a bet that the underlying the stock price will increase in value by a certain expiration date. So that's a call option. It's essentially you hope that it increases in value. So there's also put options. It's where you hope that it decreases in value by a certain expiration date. You hope the underlying will decrease in value by a certain expiration date. Call is up, is you hope it increases. Put means you hope it decreases. All right, so you can buy call options and you can sell call options. And when I mean sell, I don't mean, close your position. I mean, you can short them. So instead of when you short a call option, you're not betting that the stock is going up anymore. You're betting that the stock is going down. So if you short a put option, you're now betting that the stock is going to go up. All right. So there's longs, and you could go long on an option, and you could go short on an option. All right. And if you go short on it, it's just the exact opposite. So if you're going short on a put option, that means you want it to go up in value, or you want it to at least stand still. All right. So next, let's get into spreads. And so a spread is what makes all of these strategies that we play. So a spread is essentially just putting two options together. So for example, I'm gonna make a quick spread here. I'm gonna make a debit spread, which is a long spread. And I'll show you guys
I have a
how
meeting.
to do it. All right, so here I'm gonna send you guys a visual on what happens if I take a Tesla vertical, a vertical spread. So this is the most basic spread. This is the spread that essentially makes all strategies, iron condors, butterflies, everything. So check that out. And so if you can tell, this is not a very high probability setup. This is only, if you look the pop percent in the bottom left, where it says trading info, it's roughly 45%, which means you have 45% chance of making money on this trade by the expiration date. All right, which is not a very good chance. And let me show you guys a naked option. This is what most people trade so far, is they trade naked options. All right, so this is what happens if you trade a naked option. I'll show you the probability of making money on it. Your probability of making money on Tesla is 36%. It's incredibly low. So
no.
All right, so if you look at that, that's your probability of making money on a put option. It's about 36%. So it's not very high. So what do we do to because if you're trading naked options, that the odds are going to be incredibly against you. So why take a 36% trade when you could win a probability of making money when you could take a 70% chance of making money, for example. All right. So let me show you how to make an order like that. How do you make it so you can have such high probabilities of success? And the way to do that is you create a spread. And if you sell options, so when you're buying options, there's time decay. All right. So every day that you own the option, when you buy it, you're losing money from time decay. So it just devalues and it devalues and it devalues every single day.
Lo puedo hacer mute. A ver.
1 second, guys. And then so it devalues and it just devalues and it devalues every single day. But when you short options, which is what I mainly try and do, you collect time decay. So your probability right off the bat of making money is 66% chance. And the way that you get that 66% chance is because you either need the stock to stand still or move with your short. So for example, if I'm shorting a call option, right, on Tesla, right now Tesla is at $342. I'm shorting a call option, which means I want it to stay above a certain price. So for example, I would look on the chart, where do I think Tesla needs to stay above, for me to guarantee that I could collect some sort of profit from time decay. and maybe even a capital gain. You know what I mean? So what I do is I look on the chart, I find, you know, areas of support, areas where you could use them to, you know, reflect your option, and, you know, I select them. So for example, if I'm right now, I think Tesla is going to stay above 320. All right, that's just I didn't even look at the chart. That's just me making that up. I think Tesla is going to stay above $320, and right now it's at 342. All right, so what I would do is I would sell a call option at $340. All right, and then I would buy a call option at 317.5 to ensure that, to essentially create the spread. All right. So here, let me show you guys a visual of that on Tastyworks. So I'm gonna do that. And sorry, I might have said those numbers backwards. 1 second. Yeah. So my bad. You would buy the 320 call, and you would sell the 315. All right. So by making that order, you essentially want Tesla to stay under that price. If you're shorting a call option, sorry, and if you're shorting a put option, you want it to stay above a certain price. So because that's what I meant to do. So what I would do is I would put my sold put option at $320, because if I'm selling a put option, the assumption is bullish. You essentially want it to stay up. All right, because you're selling the put option, which means if it does hit that number of 320, for example, in this case, I'm selling the 320 put. That means that if it hits the 320, I run the risk of being exercised, because each option is worth 100 shares. So if it becomes in the money, somebody's able to exercise it and take the difference and essentially make the money off me. But that's why I make a spread to avoid that, but a spread doesn't guarantee that you won't be exercised. It just limits the risk. All right, so it very much decreases the risk. But let me show you guys a visual on this vertical spread, because it's going to be very hard to just listen to what I'm saying and understand it. But so I'm going to show you guys. So here, I posted it right now. Yeah, that's rough. If you can't sign up for the platform, just message me anytime if you need help making an order, and I'll send you a visual of how to make the order, and I'll help you out with making the order if you can't sign up. But okay, so this is what happens if you sell a put, all right, a put vertical, a vertical spread, because I would never sell a put alone, because if you sell any naked option, you run the risk of being exercised, and your risk is like insane, and the buying power is like, it's going to be ridiculous. To sell one option on Tesla, it's probably going to be like $5,000, maybe $6,000. So what we do is we create a spread to essentially reduce how much it costs to enter the position. All right, because for example, if I'm going to buy if I'm buying a call option on Tesla, which is the same thing as me selling a put spread. All right, because if I'm selling a put spread, that means I want it to stay above a certain price. So me selling a put spread is the same assumption as me buying a call option. All right. So if I'm buying a call option, the difference is, one, I'm making money off the spread from time decay, and two, why would you trade the naked option when you could buy a spread for 1/5 of the price? Because a naked call option would cost me about $800, but a put spread, which is the same assumption, it's the same assumption, but my probabilities of making money are higher, it costs $145 compared to $800 for a naked option. You know what I mean? So bottom line, you have less money down on the table to lose on top of that. So now look at the here, 1 second. I honestly forgot to put the analysis page on the thing. Let me pop up analysis. Just so, oh no, it doesn't really make a difference. You can already see the profit and loss. So as you can see, I sold the 320 put, right? Which means I want Tesla to stay above 320, okay? And as you can tell in the analysis, as long as it's in 320, 330, 340 and on, it'll be making money at expiration, all right? But as you can see, if it goes below the 315, that's when I start to lose money. So as it goes into the 320, I start to lose money, but once it goes over the 315, you start to lose, like, you know, the maximum amount lost. But the idea is to cut it before it even hits 320. So you wouldn't, because you wouldn't want to run the risk of being exercised. So this is how it works, all right? because I'm shorting it, right? So when you short any position, you're receiving a credit up front. So you're receiving money up front, and the idea is to pay your broker back with less money, all right? So what I would do is I would short this vertical spread at $1.45. So my broker would give me $1.45. So if Tesla within the next 19 days stays above $320, I get to keep the whole $145 because both of my options will expire worthless. All right. But if Tesla does go under my 320, you cut it for a loss and you take the 20, 30, 40, $50 loss that it's going to be. But remember, the most you could lose on this position is 155 for a max profit of 145. So as long as Tesla stays above 320, you don't have to pay your broker back. They will give you the $145, and as long as it expires worthless, both of the options, you keep the full premium. You keep the full $145. So I kind of explained how to make a spread. So now let's people ask questions because I'm sure people are confused. So just ask me where you're confused about. But do you guys understand how much higher the probability of making money is? Because one, you're making money off time decay. So you're not losing money off time decay like a naked option, right? So, and then in addition, you're making money as it heads towards the assumption, right? So if I'm selling a put option, that means as long as the stock goes up, that means I would also be making money, right? So you're making money 2 out of 3 ways, okay? Because if it goes down, I obviously wouldn't be making money. So I'm making money 2 out of 3 ways. But if I'm buying a naked option, I'm only making money 1 out of 3 ways. I'm only making money if it heads towards my strike price quickly, because because time works against you. So you're also losing money from time decay. Oh, sorry, 355. My bad. I didn't read that right. But 355 is if you really let yourself get exercised on. But you would really I don't know, you would not it you should cut your losses before it even gets there, okay? So for example, if Tesla right now is at 342 and I wanted to stay above 320, I wouldn't even let Tesla get to 330 before I cut my loss. You know what I mean? I would probably be cutting my loss at maybe maybe probably just at 330, you know what I mean? Because you want it to stay above, which means you would be taking a very small loss, but the idea is to, let your position right out when you're taking these spreads, since the probability of making money is so high. But the thing is, never let your option get close to that 320 that you sold, because if it does, you do run the risk of being exercised. I can't stress that enough. You run the risk of being exercised, guys. And if you get exercised, for example, say the stock is at $319 and you get exercised from the put that's at 320, all right? That means that the difference is $1 and each contract is worth 100 Tesla shares, right? So that means you're forced to pay out $1 times 100 Tesla shares, all right? So yeah, that's the math for you if you didn't understand what exercising is and how you would lose money. Okay, so I'm gonna show you my Snapchat trade, the one I'm in right now. So here, let me just pop up a similar order. Okay, 1 second. Hold up. All right, but yeah, keep asking questions so we could clear up any confusion. Where did I learn this stuff? Honestly, listen, guys, everything I have learned is from Tasty. Guys, I cannot stress that enough. They will give you all the tools you need to learn this stuff for free. Like, it's just all on their YouTube. And I'm not saying, like, you can't trade momentum. Trust me, guys, trade momentum also. But, for example, I was looking at the market, for about 2 hours on Friday, and I found this Snapchat position, right? So I take on the Snapchat position, and I'm going to let it ride out for 49 days, because that's when it expires, 49 days. And this is a very complicated position to show you guys, because this is when you get a little bit more, into it. You can start doing this type of stuff, but I'm going to, give you guys the idea of what's going to happen. So as long as Snapchat stays in between $11 and $17, I keep the full premium. All right, so let me show you guys. Let me show you the order with analysis. All right, here we go. Okay, so you guys could look at Snapchat on your charts and, judge my technical analysis if you want, but I thought that Snapchat was going to stay in between. So, because this is a more advanced, but this is, a good way to just dive right into it. So, for example, I was talking about selling call options, I was talking about selling put options. So, if you're selling a call option, that's a bearish assumption, right? So, what I did was I sold an 11 strike put option, which means I think that's a bullish assumption, which means I think Snapchat needs to stay above $11, right? So, what I did was, I did that. I did this. Yeah, that's a strangle. I sold a strangle. So I thought Snapchat was going to stay above $11. So I sold the 11 put, right? Because I wanted to stay above that. All right, and then what I did to make the strangle was I sold the 17 call because I thought it was going to stay under $17. Because if you sell a $17 call, that means you think it's going to stay under $17. So the effect of making, both of those trades at the exact same time creates, an order where as long as Snapchat stays in between uh $11 and $17, I keep the full premium because I'm shorting this strangle. I'm not buying the strangle. I'm shorting the strangle, which means I want the strangle to expire worthless, and the way for the strangle to expire worthless is for Snapchat to stay in between $11 and in between $17. Um. Okay. So how do you mean if you get exercised upon? So you literally can't get out of the position if you get exercised. But guys, remember this. So you're probably thinking like, why do you even do all this? This sounds so sketchy. If you could just get exercised on, why would you sell an option if you could get exercised on? So think about it like this, guys. One in every 100 option trades get exercised. That's it. One in every 100 sold options, options that are being written, because you could be the buyer of the option or you could be the seller, which means you're also the writer of the option. You're writing the contract to the person buying it from you. So, so for example, if I if since it is worth 100 shares, I do have the obligation, since I'm selling it, to pay them, Tesla for, the example I used earlier, Tesla at $320, right? I have the obligation to pay them $320, I have the obligation to give them Tesla at the value of $320, okay? So, the way, even if it's already, exercised upon, like even if they exercised upon and it's a way better price and they're getting a benefit out of me, I still have to exercise it and pay the difference, and they keep the money that I give them, essentially. All right, but so this is how it works. All right, one in every 100 option trades get exercised that you sell, and the odds of you even getting exercised are just very low. All right, it just doesn't happen. So the reason why nobody ever exercises options to begin with is because it's more lucrative to open up a new position. So nobody would wanna buy your option, wait till it expires, and then exercise it. Take you on those 400 shares. Because if you're buying an option, which is what I assume most people in here are doing. If they're buying an option, you're buying it from somebody who's like me, who is selling it to you. All right, which means I have the obligation to give you those shares at that price. All right, so yeah, if I do run the risk of being exercised upon, but guys, it's just so low. The probability of it happening is so low, and nobody's going to exercise your shares as long as it doesn't hit the price that you sold the put option at, for example. So in my example, it was 320 put. So as long as it stays above 320, nobody's going to exercise my option. You know what I mean? Nobody's going to exercise my option. And as long as Snapchat, in this case, stays in between $11 and $17, nobody's going to exercise any of my options. All right? Because if you look, both of the options that I'm trading right now are sold options. So both of them are being shorted, not just one of them. Both of them are being shorted. Um, so you assume they are going to sell the contract before exercising? Are you saying from a buyer's perspective, or? Oh, okay, yeah. I see. Like you're saying, if you were from a seller, yeah, talking, saying to the buyer, yeah. No, they do it. They assume. I don't know. They not necessarily, because remember, if you sell the option, you're selling it to somebody else. So somebody will always own the option until the date expires. As long as one person, starts the trend, as long as somebody writes an option and then somebody bots the written option, then from there on until expiration, somebody will always be the owner of it, because you can't just get rid of the option. You know what I mean? If you sell your option, you're giving it to another person. You're giving the obligation to another person. You know what I mean? But yeah, so from a seller's perspective, what we're doing is we're essentially expecting that it doesn't, that we're from a seller's perspective, like from me, I'm hoping that you're not going to exercise. And the only way I can guarantee myself that you're not going to exercise is if it, as long as it stays above my price. In Tesla, the Tesla example, as long as it stays above 320, nobody's going to exercise my put option that I sold. You know what I mean? Because they would only want to exercise it. It would only be smart of them to exercise it at 319 or something, because if they exercise it at 319, I'm forced to pay out that dollar difference. You know what I mean? So exactly. Exactly. Yeah, I didn't yeah, no, exactly. That is why people don't exercise. It's not lucrative to do that when you could just open up a new position altogether. And Tasty stresses that. But okay, so I say we get into high probability setups, and the way to make a high probability setup, and like the way to how do you make option trades that are going to be successful. So one, I just don't buy options, guys. I mainly am receiving a credit up front and hoping that the options expire worthless, which allows me to keep the full credit. But I'm gonna get into profit, and risk later. I'm just assume that I get in, to try and keep the full credit, because I don't, but assume that I did. Assume that my goal was to keep the full credit, okay? At expiration, all right? So, for example, let's pull up like Tesla. So if you're selling if you're selling any option, all right, no matter what it is, you want to sell the option when IV ranks are high. So when IV is high, because you're going to hear that a lot, implied volatility. When the implied volatility ranks are high, that means that the value of the contracts are essentially inflated, and it's not worth that that price essentially. You know what I mean? That's what the market doesn't feel like it's worth that price. It feels like the contracts are inflated in value. All right, so that's why you sell options that are high IV, because if they're inflated in value, the idea is you want them to deflate in value essentially. So this is what I do. So, for example, Tasty, they have a section where you can look at IV ranking from high to low, on the biggest tickers out there, because I mainly only trade blue chips. So, Apple, Netflix, Starbucks, Tesla, Caterpillar, like, construction, GM, Microsoft, Google, like big companies, okay, big companies. And all these companies have high IVs right now. In this market, they have high IVs. So what I would do is, they're inflated. So, for example, let's go to Tesla, just because Tesla is a beauty. But so go long term, and if you see Tesla long term, it has a big range, all right. But for example, I could make two spreads. So instead of just making one spread, I can make two spreads, all right? So instead of just selling one vertical spread, so say I were to sell a call spread, right? That's a bearish assumption. So instead of just selling one call spread, I'm going to sell a put spread with it. And that creates an iron condor, which an iron condor is simply just two spreads in the same position. And you're hedging them to trade it within a range. So if you're buying an iron condor, you want it to trade without that range that you picked. So for example, if I pick the Tesla range of 320 and 340, if I'm buying an iron condor, I want it to stay out of that range. But if I'm selling an iron condor, if I'm shorting the iron condor, I want it to stay within that range. I want it to stay from 320 to 340. It needs to stay within that range. So now, this is how we're going to make an iron condor. I'm going to show you guys an example. So Tesla, for example, if you look at, I'm going to just, give it briefly. I think Tesla's going to stay lower than $400, but I also think Tesla's going to stay above $280, all right? So what I'm going to do is I'm going to create an iron condor, and I'm going to put the sold put option, because I'm selling the put option, which is a bullish assumption, since I'm selling the put option. I'm going to sell the put spread at $280 because I think it's going to stay above 280. So I'm going to sell the 280 put, essentially. All right? And then what I'm going to do is I'm going to now look at the call option that I sold, and I'm going to put that up to $400, all right? So now we're going to change that to $400. So now I'm going to show you guys this order. You guys can see how it looks. All right. All right, so check that out. First thing you need to look at, what's the probability of making money? 77% chance. That's the probability of making money is going to be on these iron condors and these strangles are going to be higher than you've ever seen. Because if you looked at a naked call option, for example, what was the probability of making money? It was like 37%. I sent it earlier. And if you look at this iron condor, as long as Tesla stays in between $280 and $400 within 19 days, these next 19 days, I keep the full credit, which in this case is $80. That's the limit price that's, in the middle of the screen, which is essentially your max profit. So that's how that works. So yeah, you need it to stay within that range. And you're also, I don't want to say, because I'm honestly not experienced enough to say that you for sure collect time decay from an iron condor, but I believe the time decay is positive. As long as you pick the right strikes. You need to pick the right strikes, and that's important. So what I suggest doing is it's going to be a little bit hard to understand what strikes to pick. Because I know you're probably looking at me and you're like, all right, you're just thinking, where's it going to stay in between? But I don't necessarily do that. There's a little bit more to it. I also look at the Greeks and I make sure that I'm getting the right option. I don't just, pick where I think it's going to stay in between. Like, for example, Snapchat, I don't think it's going to stay in between $11 and $17. But I chose those strikes very specifically just to make it so no matter what happens with Snapchat, I'll have a positive time decay. Since I sold two options, I have a positive time decay. And on top of that, I won't be losing any money because I chose the strikes very specifically. So as long as it stays in between that price, I can't lose money. So I mean, there's nothing really to show here, but I could show you 2 hours of my, I could show you what happens within like 2 hours of this position. So this is 2 hours of the position. I made like $1. You know what I mean? I made $1. So if Tesla spikes up tomorrow over 400, then will the IC be a loss? Yes, not only that, you run the risk of being exercised, but that's why I honestly don't suggest playing Tesla, because it's very, very volatile, which is why I chose Snapchat. I chose Snapchat very specifically because if you look at Snapchat, they don't go anywhere. They don't do anything. You know what I mean? Like, it's the perfect option to sell. And on top of that, right now, Snapchat just crossed the mark to where I like it to where I like to short it, all right? Because the general idea is you want to short options over $50, all right? I mean over the IV rank of $50 of 50%, my bad. So the implied volatility needs to be over 50 for you to be able to short it. You wouldn't want to short any, iron condor, any vertical, no matter what it is. You would not want to do it unless the IV rank was over 50%. That's huge. But if you look at Snapchat, that's literally like a couple hours of the position being open. I made like $1. It's nothing, but it's something. And if you look, so the theta, see where it says theta? It's a little bit cut off. It's 2.05. So that means I'm going to be making $2.05 while I sleep every single day, just from time decay. But it's not time decay; it's positive time decay. So since I sold these options, I sold them to people that are buying them, right? And they're you know how when you buy an option, how it loses value every day? The value that it loses every day is going to the seller, all right, which is me in this case. So I'm collecting $2 every single day by making this position, and it gets exponential. So right now it's 47 days out. This position is 47 days out. So as it gets to about 30 days, I'm going to start collecting a lot more theta. But $2 is still, not bad. So, very, the idea though is to just be collecting positive time decay. That's what you want. Why trade an option when you can collect positive time decay? You know what I mean? Why trade a naked option? You could just collect, positive time decay instead of giving the time decay, instead of, spending the time decay and giving it to the seller. So, but the idea is you can't just short anything. So just remember that it has to be IV rank over 50. But you could still buy spreads with IV rank under 50, but I don't know. You need a serious move. You need a serious move. The fact that the contract values are inflated just helps a lot. It just helps you out a ton. So that's my take on it. But yeah, let's get some questions so people could start understanding it. But yeah, so just to give you an idea though, is my theta is positive, and if I were to have bought in an option, it would be negative. All right, so just keep that in mind. But how about covered calls? I honestly have never covered my position. I only have played a naked position, a naked spread essentially. I've never covered it with shares before, just because I honestly don't know how to. Like I watch Tasty, they do it all the time. They'll be like, oh, buy 100 shares of this to offset your position. But the thing is buying one option is the same thing as buying 100 shares. And to be quite honest, I don't even have the money to buy 100 shares of Tesla. You know what I mean? So it's like the idea is you buy these options to preserve your capital and to be able to put your money in more places at more times. You know what I mean? So the idea, so this is my take on it now, is what I'm going to do is, for example, that Tesla position, the probability of making money was 77%. So the idea is to find 10, 20 positions just like that are high probabilities of making money, and just diversifying your money in tons of different places rather than just having it rely on one market. You know what I mean? You could be diversifying in, you could be trading options on futures, you could be trading options on ETFs, you could be trading options on SPY, you could be trading options on Tesla, Starbucks, all these big companies, everything. You know what I mean? There's so many places where you could trade options. So that's why I suggest everybody trade spreads. So kind of just like a summary, honestly, is the reason why you should trade a spread is to, one, collect positive time decay. Don't let them take the money from you. Collect the money, all right? Don't let anybody take money from you. So that's one. Two, the reason why you want to trade spreads is to reduce the amount of money it takes to get into a position. Because if I want to get in Tesla, a naked option is going to be like $1,000. But if I want to make a spread, it's only a couple $100. You know what I mean? So the idea is you could get more spreads with a defined risk. You know what I mean? And this, you essentially risk less money. Sure, you are paying more money in commissions, because you are buying two options. But yeah, definitely the way to go. What's up, Scoop?
Hey guys.
But does anybody have questions? I don't want anybody to be like completely lost after this. So anybody that has questions, feel free to ask, and I'll go over anything.
EEAD or aid? You're talking but not?
Okay, so the idea is a small account. So generally, I will be honest with you, you are to be able to diversify multiple options positions in a tons of different places. You're gonna want to have to put around $2,000 to $3,000 at minimum aside to be able to do stuff like this. But that's if you want to do it, constantly. If you want to just try it out, go ahead and put down, a couple $100 on a spread, and you just try out making some positive time decay on a spread. You know what I mean? You don't have to dive straight into diversifying in 10, 20 positions. You could start out slow. But for example, a small, for example, like this iron Condor, all right, because a small account, depending on how big the account is. So let's go to the same spreads, $280 and $400. I need Tesla to stay in between $280 and $400. So the capital requirement to enter this position is $400, $420. All right, $422 to be exact, with commissions. So Yeah, that's the idea. Is it's going to be about $400 put aside for, in this case, 19 days. But now that you guys are kind of getting the point, let me give you more like pro tips. So the pro tips are: one, you never want to hold until it expires. I know the thought of, wow, I could just hold and collect the full credit. Yeah, that sounds great, but guys, it's very risky. The idea is you always want to take profit at 50%. Okay, 50% profit is the way to go. Okay, 50% profit. So just remember that. So for example, in the snapshot position, my max profit is $84. I want to collect $42. That's my idea. And if you're wondering how much it costed to get in the snapshot position, it was $216. So essentially, I'm putting $216 aside for a high probability setup that has about an 80% chance of happening, and I'm putting $216 aside for to make $42, which is about a 20% return on capital, which is very, very good. And this is how hedge fund traders trade. They take big accounts. They take 10. Well, obviously, they're using millions and millions of dollars, but they buy a ton of different spreads and they diversify them, all right? And they do a ton of high probability setups. So if they're doing, 10 high probability setups that have an 80% chance of being in the money, then they can expect that they're only going to lose 2 of those trades, which means that, their chance of making money is going to just be incredibly high. And you don't have to take the max loss on those 2 trades. So say you trade 10 times and you're hoping to only lose 2 times out of those 10. So you're trading 80% probability setups and you're doing 10 positions and you're diversifying 10 different positions. If you guys could understand all that. Sorry, I know it's a lot to wrap your head around, but yeah, so if you just do that and you cut the losses, because I know it sounds great to say in theory, let the winners ride and cut losses early, but it's not possible with these spreads. With these spreads, you need to almost ride them out to the fullest. So I suggest just riding it out, and when you're really not trying to lose any more money, just cut the position. And set a mental note. Be like, all right, I'm not trying to lose more than $20 on the spread. No more than $20 on the spread. All right, but yeah, sorry for the inconvenience, guys, but my mic's going to die soon, so we should get some more questions in here before I got to head out. Sorry, in the put spread scenario, if it doesn't look like price will drop anymore, we can close. Yeah, so one, guys, if you have a spread and you're expecting, in my example, I think Snapchat's going to stay in between $11 and $17, I can cut the position at any time. So you're not obligated to hold it for any amount of time. You could cut it at any time for any amount of profit for any loss that you choose. That's, under your standards. And, sorry, what was that? If it doesn't look drop anymore. Oh, no.